Hello everyone, welcome back. My name is Badman Bada, founder of In My Own Opinion, where we break down money, markets, and the global economy in a way everyone can understand. And as always, this is not financial advice, this is financial education so we can understand how money moves around the world. Today I want to talk about two important things: how last month's global news affected the economy and financial markets, and how India's latest budget presentation is affecting markets this week. Let's break it down simply. Last month, global markets moved mainly because of inflation concerns, interest rates, and fears of economic slowdown. In simple terms, when inflation stays high, central banks keep interest rates high. And when interest rates are high, loans become expensive, businesses invest less, consumers spend less, and economic growth slows down. When growth slows, markets become nervous. Investors then move money away from risky assets like stocks and crypto into safer assets like bonds or cash. That's why last month we saw strong market volatility, currency fluctuations, commodity price swings, and investors becoming more cautious. In finance, money usually moves before problems fully appear because markets always react early. Now let's talk about India. India recently presented its national budget, and this matters because India is one of the fastest growing major economies in the world. A country's budget tells investors how much the government plans to spend, how much it plans to borrow, which sectors may grow and which sectors may struggle, and markets react immediately to this information. After the budget announcement, markets became volatile. Stock markets initially dropped, bond yields rose, and the currency showed some weakness. This happened because investors felt government borrowing might increase and some trading costs or taxes might change. Whenever investors see uncertainty, they usually sell first and analyze later. But here is the part many people miss. The budget also focuses on infrastructure development, manufacturing growth, job creation, and long-term economic expansion. So while markets reacted negatively in the short term, long-term investors are looking at future growth opportunities. Markets often panic in the short term but reward strong long-term planning. The key lesson here is that markets do not move randomly. They move based on government policy, interest rates, economic growth expectations, and investor confidence. So if you want to understand markets, don't just watch price movement, watch policies and news because money follows information. In my own opinion, short-term market reactions after major announcements are normal, but long-term opportunities usually come to people who understand how economies move. So instead of panicking when markets shake, try to understand why they are moving. If you learned something today, kindly like the video, share it with someone learning trading or investing, and subscribe so we can grow this knowledge community together. No courses, no signals, just real discussions. This is Badman Bada, founder of In My Own Opinion, and I'll see you in the next episode.